For those of you who don't know, this is my son, Trent. He has done another video with me. Trent is a active financial advisor. He's licensed in Alabama, Florida, and numerous other states. And he did a video with me that we got a tremendous reaction from about 2 weeks ago. And we titled it, Let's Talk About the Markets. And that's what we want to do today because we have a lot of things up in the air right now. Everything from our president with the coronavirus to a new Supreme Court justice to a pandemic that we're going into second wave to another stimulus program, which our president just said it isn't going to happen until after the election. So there's a lot up in the air. And when we're in that kind of position, you need to really give some thought as to how you're invested and create a plan that you can follow until the circumstances change and get that person in your head under control. So what do you think about the markets, Trent?
Well, they're exciting. And I was telling a prospect the other day, I said, I really love this time because I love volatility. Okay. I mean, I'm not the kind of like just even go kind of person. No. I like volatility. And I think volatility really proves where you stand and where your knowledge base is. Okay. I'll be straight up and honest. I am smarter today than I was before March 11th of this year.
I think most of us are.
Yeah, well, I don't think so.
Yeah.
I don't think so. And here.
Oh, you don't think most of us are smarter?
No.
Okay.
No,
Tell me why you say that.
Well, I say that because of the conversations I've had with people about what they're thinking about markets, about economies, the whole bit. And in our last video, I mentioned the liquidity phase, the hope phase, and now the insolvency phase. I'm driving up here today.
Trent lives in Florida. I live in Alabama.
And I am listening to the talking heads on CNBC.
Yeah.
And these geniuses who are of the Fed, this one person, this lady saying, she says, we're growing, we're recovering, we're all this. And I'm like, wait a second. You have 800,000 people who file jobless claims every Thursday on average.
Yeah.
And you have over 20 million people unemployed. Okay? You're not...
And more being unemployed every day.
The number of working hours per person who are actually working is higher today than it was pre-COVID.
And that is because
companies are getting their employees to work more.
To get more out of them.
Get more out of them, but to avoid hiring because they don't know the future of their company. They don't know the future of the economy. Okay? So now you're in a situation where we have an enormous amount of group of people are just hope. Oh, this is going to recover.
Yeah.
This is all going to happen. When you inflate a balloon with helium and you just keep inflating, at some point it will blow, right? So here's my concern. Today I had me and my team had a meeting we manage 401k plans for companies.
Okay.
And we had a meeting with this prospect, and we do the first meeting, it's an introduction, who we are, 30 minutes, blah, blah, blah. Let us show you some value. So we do a investment analysis on their lineup. So today was a presentation of that investment analysis. And what blew me away was that, number one, nobody's been paying attention to this for at least 10 years.
To their 401k.
To the 401k, the allocation.
Okay.
It just hasn't been actively managed,
okay.
Right? But the biggest holding, this is a multi-million-dollar 401k plan for the company, many employees in it, right? The biggest holding is this large cap growth fund, okay? Which has done stellar.
Would it be one of my big six?
No, the growth fund. It's a large cap
mutual fund. Okay, a fund.
And so you got holdings in it. It's one of the largest out there.
Okay.
30% of the assets in that fund are in 5 of your big 6.
Okay. We know who those are.
Okay. So I look at that and I go, that is an enormous amount of risk concentrated in in 5 companies in a full-on retirement plan. Okay. Here's why I get freaked out about it. I mentioned beta last time.
Yes.
Okay. Let me explain what beta is and how we're going to use this in portfolio construction. Okay. Beta is a measurement of risk. So if I use the S&P 500, it has a beta of 1.
Okay.
If I have a portfolio and it has a beta of, say, 0.65, that means I'm taking 65% of the risk of the S&P 500.
Okay.
So if the S&P 500 goes up 10%, I go up 6.5%. But most importantly, and always, this is the number one thing you have to be asking yourself when building a portfolio, how much can I lose?
Downside.
So if the S&P 500 goes down 10%, that portfolio will go down 6.5%. Okay, so go flashback to the great financial crisis, 07-09. Okay, the average person from the bottom in March of 09, or March or April of 09, took 4 years to get back to where they were prior to 07.
Okay, 4 years.
4 years, okay, because they lost so much. So, if you lost 20%, you got to hammer out a 30-40% return
to make up your 20.
Exactly. And it took 4 years because once you hit the bottom, all of a sudden you become, oh, well, maybe I don't know what I'm doing. All right. Maybe I should asset allocate and I reduce my risk at the bottom.
And therefore your growth is not subsequently higher.
Exactly.
Because you've actually moved your beta down at the wrong time.
Right. Okay. When you should have moved your
at the high.
At the high. So beta is that measurement of volatility in the portfolio. So if you take an individual stock, one of your 6, one of them has a beta of 1.28. Okay.
So he's 28% more volatile than the S&P 500.
Or it's assigned benchmark, whatever
it is.
Exactly.
Okay.
All right. So when I allocate my equity positions, I don't allocate any more than 6% to any one equity position.
Okay.
But I then calculate in what the beta of that stock is.
Okay.
So if it's 1.28, the real allocation when it comes to risk is more like 7.58 or something of that sort. Okay,
so you're moving up the allocation because it has a safer beta. No.
If I allocate 6%, like that's my allocation.
Okay.
My real risk factor is 7.58.
Okay.
So then I recalculate that down to maybe whatever the calculation is to get to 6%. Okay. So that's my equity position. So if I'm bullish on the market and I'm heavy equities, I don't allocate any more than 6% to those positions.
Anything.
Because
so that pretty much dictates you're going to have over 20, because if everyone was 5%, you'd have 20 stocks in your portfolio.
Right.
Okay.
So if I am full on 100% ultra aggressive, I have no I'm straight equities.
Right.
Okay. So I got it's a big portfolio, but it's a manageable portfolio, and it's a portfolio that doesn't blow up based on one position's move. Okay. And that's where I think a lot of people can get really caught up in, the hype of some of this very narrow rally. And that's what I'm seeing in that mutual fund. That all of a sudden those positions have grown to be 30% of the overall movement of that portfolio. And that allocation percentage doesn't include the actual beta risk assignment to those positions. So if that one, the average position is say 5.25% allocated percentage-wise, look at its beta, and it's probably more like 6 something.
Okay,
you following me?
I am.
Okay.
I am.
So you build this portfolio. You figure out your asset or your beta construction of that portfolio. When markets go up, so for instance, our 6% position a month ago became 15%.
Okay, because of the high performance of that individual stock.
Plus the beta
So
element to it.
its financial number was higher
It's out.
because of the increase in its price.
It became 15% of our overall portfolio allocation.
I understand. Okay.
So we saw that. You apply the beta factor to it. We then, first of all, let's step back one step. We look at volatility. So the macro side of things. Where is the intermediate trend? And when I say intermediate trend, I'm looking out 90 days. Okay. That gives me a true trend. A trade is say 3 days.
All right.
Okay, or 3 shorter periods. A long-term trade is 3 weeks. Okay.
Okay. A trade.
Trade. You're looking to buy here, sell there. Okay. A trend, if you're a long-term investor, you're looking at that 90-day trend or 3-month trend. Okay. It gives me a true commitment to where the market is going, that kind of thing. So I look at where those trends are, and I look at it both from the stocks to the bonds to the economic fundamentals, job creation, everything. And I apply that. And when I start to see those trends break down, I then make some decisions about where we're going in the intermediate trend, the next 90 or so days. And what that tells me is, like, for instance, back in September, or the 1st of September or so, it was telling us we're running out of steam. The locomotive is run out of coal, and we're starting to hit that uphill. So we take that information and you rebalance your portfolios. You take your profits. I mean, nobody complains about taking profits. And I mean, if you got to write a check to the IRS for those profits, I know you don't.
But if it's in a 401k, you don't.
Well, or an IRA, or a qualified account, you don't.
Wait a second. You said something. Having been a financial advisor, you're managing 401ks on a 90-day scale?
No. So 401k world is different from individual retail world. So we have 2 books of business.
All right.
401k is guide. It's management over the day-to-day operations of the of the plan, all your RISA, DOL, IRS guidelines, all that kind of thing.
Okay.
So we got a team member who focuses on that. Melt your brain when it comes to government law when it pertains to 401ks. We advise on the lineup of that portfolio. We guide people when they come to me and say, Trent, I don't know what to do with our investments in my 401k. Am I properly allocated in relation to my goals and my risk tolerance?
That's a very good point, because the question I ask you, are you managing a 401k on a 90-day basis, isn't really practical, because if you've got 200 people in that 401k, you have 200 different circumstances. You have multiple ages, you have different levels or time levels to retirement, as opposed to a 30-year-old who has. So, I understand that.
But here's the thing that bugs me about my industry when it comes to 401ks. It's a long-term investment. You take it out after you retire, or when you retire, you use it as income, that kind of thing. But it's not something that you just sign up for
and forget about
it.
God help you.
Because
that is so important.
Because that is what I looked at today, was somebody signed this up 10, 15 years ago, selected the investments, and never
gave it another thought.
Never gave it another thought. And there's like, in my opinion, there's risk all over this plan.
So wait a second. So
Okay.
if one of our viewers has a 401k and they work for a major corporation and they've been working for them for 15, 10 years, whatever, what should they do?
I think they should understand their plan from the perspective of.
I mean, who do they contact if they want to sit down with somebody and say, what is it? What do I have, and what is my performance, and how is that performance relative to other investments over the past? So how does that happen?
So if you're an employee, the first step is go to HR and say, listen, I need some guidance on my 401k. The first thing they should say is, I can't give it to you because I'm not licensed and it's not our position.
That's important to know. Your HR person can't give you advice.
If they say, oh, I'll tell you what to do.
Yeah, turn and run.
Well, they're walking down a very slippery slope.
Okay.
They should give you the advisor who is on the plan or the number. You contact them, tell them I need some advice on my retirement plan. Can you give it to me?
Okay.
Now, there are two levels of advisors in the 401k world. There's the advisor who can give specific advice, allocation advice, and then there's the generalist advisor who can't give that.
And this has something to do with their level of their license.
It's how they signed on to the plan, their risk element. So I can be a 321 ERISA 321 advisor, which means I'm
That's ERISA.
Don't ask me what that is. I know what it is. It's employee retirement, whatever.
Yeah.
But what it is my team and I are co-fiduciaries on this plan.
What is a fiduciary?
Meaning I act in the best interest of my client. I am legally liable for the investment decisions and decisions
and advice that you give
that the employee takes on.
Okay.
So now there's some guidelines there, that safe harbor things that help protect us, but we have to meet those safe harbor things to get us, basically protect us from you suing me for your bad decisions to neglect your portfolio.
Okay.
So you contact your advisor, the advisor of the 401k plan, and he or she says, yeah, I can meet with you. They want, number one, they should define what your risk tolerance is, what your goals are, what your time frame is. Get to know you. Okay. All right. They're getting paid. All right. They're getting paid to give you advice. Now, if it's a generalist kind of advisor, and you fill out their risk tolerance questionnaire, and it says you're a moderate allocated person.
Right.
He or she can only tell you that you can invest. A moderate is a 60-40 split: 60% stocks or equities, 40% bonds. Okay. If that's all he can tell you, most people will take that information. They will go to the fund lineup. And they will go through the funds and go, which ones performed the best?
Yeah.
Okay?
Yeah.
So you're buying on past returns.
Okay.
So
which
is
no indication of future performance.
Right. So last year, your large cap growth was up 20-30%. You bought that. And depending if the plan is properly managed or not properly managed, you may have more than just one choice in large cap growth. You may have 3 choices.
Okay.
Behavior studies tell us that you will buy all 3 of those large cap growth funds,
right,
in your plan, and that will become 60% of your portfolio.
Right.
What you don't understand is all 3 of those
own the same stocks,
and they got the same risk.
Right.
You're not diversified.
Okay.
A true 401k advisor will walk you through a true asset allocation. Okay? If you're starting out in these, if you're literally one of those people, I just want to set it and forget it, there are things called target date funds. Okay.
Yeah.
These were created back in early 2000s after
remember
the
that.
tech bubble.
Right.
And what they are is they're designed to, so for instance, I'm 51, and let's say I'm going to retire in 2035, which I'd be about 66 or so.
Okay.
So that's 2035 here. Today's 2020. It's more of a moderate, aggressive allocation. As I get
Closer
to that, becomes more and more conservative. Most target date funds, though, anticipate you're going to live 20 years beyond 65.
Okay.
So say 85. 85. Okay.
Yeah.
And you are not, in your behavior in the past has demonstrated you're not going to readjust this portfolio on a quarterly basis. You're not going to actively scale down the risk.
So it's doing it for you.
Yeah, so when you get to 2035, and this is where like in 2007 to 2009, 2010 target date funds, meaning the retirement year of 20, people assumed that 2010 fund was all cash and a couple, bond exposure.
Yeah.
So you shouldn't have, gotten
hammered
too bad. But you did because they didn't read the fine print.
Okay.
Because that 2010 fund is really allocated to more of a 2030 fund.
I see.
It's more of a moderate allocation.
Because it's going to not only take you to retirement, but through retirement.
Through retirement. So there are very few target date funds that are to retirement.
Okay.
So
that's your 401k.
Yeah.
A lot of my viewers have a 401k, and I think that was perfect advice for them. Then they also want to invest on their own.
Yes.
Because I am of the opinion, if you're an employee, you need another gig. You need a side gig that you're running through a sole proprietorship, a partnership, or an LLC, and you're collecting money and you're managing that money, and that's outside your 401k. Yep. If you're an active participant, my strategy is I don't want diversification. If I'm actively watching the market, I know and I can anticipate with some certainty, particularly if I belong to this tribe, as to what is going to happen. And I'm actively managing my own portfolio. I don't like diversification. I do not want to own oil right now. No. I don't want to own energy. I don't want to own retail. So I'm not diversification. But in my 401k, if I'm a 50-year-old or a 30-year-old, I probably have some of that.
Right. Well, unfortunately, all your large cap growth, large cap growth, mid cap growth, small cap growth, they're all heavy tech.
Yes.
Okay. So you don't like diversification.
No.
But your big six are a form of diversification.
Because
of what they do. So one of those, it's a jungle in reference. Okay?
Yeah, down in South America.
That is a company.
That's a retail company.
Hold on. That thrived during the worst.
Thrived during the pandemic. Yes.
Okay. Compared to the automaker.
Yes.
I didn't go anywhere. So I didn't need a car. So I'm not going to buy a new car. So
you and I have had this discussion before. And
you're diversified very on a micro level.
Yeah.
Okay. Unfortunately, they're all connected because they're in
the technology.
They're in every mutual fund, ETF, index ever, right?
Right.
So how can you, who believes 100% in tech, okay, that's going to change your world. That's going to change how you live. You're going to live longer. You and I will be having this conversation when you're 210 years old.
Yeah, that's my book over there, Lifespan.
Yeah, exactly. Technology is going to change it.
Right.
But there's you can diversify within technology.
Okay.
So there's software, there's hardware, there's all this different technology.
Okay.
And you can diversify in that. And by building a diversified portfolio within technology, let's say, First of all, I'm not advocating you do this. I'm just saying if you're...
It can be done.
Yes, this is not advice. This is just my opinion. I got a disclosure.
You
the whole
see
bit,
that?
right? I got a compliance department. So my point is, go diversify within that sector and then apply risk management strategies to this, okay? So there will be companies that tanked today based on Trump's announcement, right off the bat. I own the big six, well, except for one, okay? They all took a hammering. One of them was down 2.5% or so, okay? But my other software positions, my other transportation positions, and my exposure to, say, the treasury market balanced that out, okay? They are not as high beta. Some of my technology positions are like low beta positions that are software, that are information security.
Now you can't tell us those names because your compliance doesn't allow you to. But if you want those names, and I'm going to just tell you this, whether he likes it or not, I'm going to put his name and his phone number, and his website and email address in the description. So if you want some specific information on how you can diversify in tech, I encourage you to contact him. Don't contact me. Contact him.